Morning, everybody. Mike Tedeschi, Wealth Management Advisor over at Perspective Wealth Planning. With this week's market breakdown video, we're going to take a look at the four major U.S. indexes as well as oil and gold. We'll take a look at some sentiment data as well as breadth readings as well. If you guys like the content that you're seeing, please feel free to subscribe to the channel so you can get these updates on a weekly basis. Well, let's jump right in here. Now, the first thing I want to talk about here is the S&P 500, and I want to look at a potential fib retracement level, i.e. a zone where we might see some resistance here on this bounce to the upside. Now, a fib retrace level is basically laying out a retracement of the previous move. So the 50% level is very, very important. It means that the market would have retraced 50% of the previous drop in this particular instance. Now, that level comes in right at about that 2790 zone. That 2800 level is one. When we zoom in on an hourly chart, we can see the beginnings of our resistance zone right in here. That 28 to about that 2900 zone is a very important level. So that's also the 50% retrace from the previous high, and that is a zone where oftentimes a bounce will fail. It doesn't mean that this one will fail at that level, but it is a key level that we are watching. That 2800 level also goes back to this major support level from the end of last year. So this 2820-ish level acted as support last July and then again in September. So this is going to be a very important key level. If the bulls can drive us back up over this line, it really does alleviate some of the pain that we have had here over the last couple of months. And our next target on the upside would be that 3000 level, which was the previous resistance zone before we had our breakout there in October and the beginning of November of last year. So very, very important action that takes place right here at this zone. We back this chart up on a monthly basis. We still can come in here and look at where we found our initial bounce from was a major important support level, and that was that breakout from back in 2016. So far we have held that zone. Now, interestingly enough, the larger pattern that has been kind of put in here as of late is what's known as a megaphone pattern. So we have a series of lower lows and we have a series of higher highs that have been put in over the last 2 years. A break underneath of this zone, this would be known as a megaphone topping pattern, and that would subsequently lead to a much further drop. And we've talked about some of those further down levels here. I really think that 1500 and that 1800 level are the two most important zones below at 2200. But just because it's set up like a megaphone here doesn't mean anything until it actually breaks below that level. So as it sits right now, we have held the major support level. We have made a bounce back into about the middle of the range. And you can clearly see that if we just kind of draw a line right in here at 2800, you can tell that that is essentially the middle of this zone. You've got 600 points right here to the downside. And if I duplicate this drawing so that you can see what it looks like with that 600 points there on the upside, we're right back at about those highs. So this is the middle of this zone. What happens here is important. We get back up above that. That's more towards the bullish end of that range. And if we stay below that, if this acts as a ceiling and we get rejected, we would be trading in the bottom half or the bearish zone of this range. Now, let's take a look in at the Nasdaq, which what I want to point out here is the Nasdaq has been a clear leader here for quite some time. This year to date, the Nasdaq's only down 5.5%. And with the move here pre-market on Thursday, we're up about another percent or so, about that 8,400 level. It's barely down for the year, which is pretty crazy thinking about everything that we have gone through economically and in terms of our life changing. That the Nasdaq is only down 3% for the year is pretty amazing. It has been a clear leader and still continues to be. It's down the least for the year. Its bounce subsequently has been strong. And if you notice, the major thing about the Nasdaq that I wanted to point out here is we did not get down to the 2018 lows. We held up here. That's a very, very good signal that we did not see as deep of a correction out of the leadership in this market. So the Nasdaq is certainly something that we want to continue to pay attention to for that potential leadership signal. If it could get green for the year, that would be incredible. And we're, again, not that far off of that actually happening. Now, when we come in here and take a look at the Dow undercut the 2018 low by quite a wide margin. So it acted extremely weak in comparison. It's back up above that 2018 low at this point in time. That next zone of resistance really up there at about that 24,800 level. And that's what we're paying attention to, is that next resistance. So on the Dow. Again, this had been weaker in the beginning here. It has subsequently recaptured that 2018 low, but it still has a lot to prove. We come in here and we take a look at the Russell. The Russell, as we know, and as we have talked about extensively here over the last few years, it has been a major lagger. All right, I'm going to go ahead and clean all of these lines off of the chart so we have a fresh one for today's video. But all the way back down to 2016's lows, still below 2016 breakout zone there at that 12,600 level, way off of the highs, by far the worst year to date, down 37%. At its depth, it was down over 40% year to date. So the mid and small caps have been eviscerated so far this year. They have been extremely weak. They didn't go and make new highs in the beginning of the year and have led to the downside. It's really, really important to see this get back up over that 12,070 level, 1,270 level. If we don't get back above that zone, it's going to be very hard, in my opinion, to see the market really make that push all the way back towards those highs. You need full participation, especially out of an area of the market that has been so demolished here this year. So we're going to continue to pay attention to that level. Now, next, I want to talk about oil. Oil is sitting on 20-year supports down in this 17 to 22 region. We kind of came down into that zone and subsequently have made a bounce here. And a lot of this bounce has to do with news. We've had multiple comments out of the Trump administration in terms of maybe some tariffs. There's something he can do to help raise those prices. Saudi Arabia and Russia coming to the table to try to remove supply from the market to help lift prices. A lot of information has come out, and the market really still hasn't made too much of a move. It held that low and made a little bit of a bounce, but you can see there's still just a ton of technical damage that's in on this chart. 30 to 34 is a major ceiling that's in place, and then we have this major gap from the original news between 34 and basically 42 that will also act as a major resistance zone. There's a lot of issues going on inside the oil space. It was constructive that we held that lower 20-year support zone. And even though on a percentage basis, we have made what looks to be a pretty good bounce, it's up 34% off the bottom, still year to date, oil is down 60% or so. So there is a lot of damage in on this chart. And with everybody still under lockdowns, quarantines, non-essential businesses need to stay home across the U.S. and the globe, the demand for oil is still exceedingly low. So it would take a supply side event here to really kind of push things higher. And even with that in place, we still need the demand to increase. So it may be a while before oil really starts to make a move higher. But a move back up would be very beneficial for a lot of reasons. One thing, the Russell 2000 is made up of a lot of regional banks. It's about 20% of the index. Well, regional banks do a lot of loans in the U.S. to small oil and gas companies. And a lot of those loans subsequently with oil prices down here are going to come under pressure. So if oil can get back up, that actually could alleviate some of the stress that's happening in the regional banks and subsequently the Russell 2000, and would be good for the overall economy. So we're going to continue to pay attention to what happens here in the oil patch. The other area that I want to talk about this morning is gold. Now, I want to back this up and look at this on a monthly chart. The Fed this morning, after the jobs announcement, where another 6.6 million people were unemployed in the last week, said that they would put another $2.3 trillion into the economy. The Fed continues to give us that backdrop of protection, but at the same point in time, their tool that they're using at this point is more and more and more money. That subsequently, at some point in the future, should cause some sort of inflation, because the more money is, so to speak, out there, the less value it has. They're basically devaluing the dollar to make sure that small businesses have loans and people have money in order to weather through this storm. And that, of course, could certainly be a beautiful tailwind for gold. And if we look at gold here on a monthly chart, we've talked about this a number of times, there is that cup pattern that is getting set up, and it's played out over the course of a decade. We had the break earlier, middle of last year, over that 1380 level, and so far we have seen continued move higher. We had a handle that was put in at the end of last year, and we subsequently have continued to push up. Gold is running out of resistance zones here if it can push just a little bit higher. The highest monthly close in the last 10 years or so was that 1770 level. We did have in August of 2011, 1830. So this is going to be your resistance zone, is that 1770 to 1830. And then, of course, you could put another one up there at that 1923, the all-time high prices. But above that, there's no resistance, and we have built a very long base and subsequently have started to push up. What happens to gold around this 1800 zone is going to be very, very important. There is a lot of extreme bullish sentiment in the space, which might not necessarily be great over the short term, because if everybody is on one side of the ship, of course, we know how that works. So something like this playing out would make some sense here over the long run. We're going to continue to watch this as a potential safe haven zone as we move forward with the Fed continuing its printing. Let's now jump in and take a look at some breadth readings. The Nasdaq McClellan Summation Index, after making its turn there in the end of March, where stocks ultimately did put in at least a short-term bottom, we have seen breadth readings head back higher. The crazy thing is we're still almost minus 1,000 on this chart, which is well below where we have spent any time in the last year. And it is also in that zone where negative things can continue to happen. The nice thing is we are pointed up, which means breadth is improving, but it was absolutely unbelievably abysmal there at the end of March. So an improvement here is still, on a historic chart, still very poor breadth reading, so to speak. We would continue to see this maybe make a move higher. What will ultimately be important is how this acts if we continue to push higher here over the next week or so, up in this -4, -500 zone, because that could act again as resistance before ultimately turning back down. That is certainly a potential play. So we're going to continue to keep that at the forefront in these videos. The last thing I wanted to speak about in this video was the Smart Money, Dumb Money Confident Index. We've talked about this a number of times before the market pulled back. We talked about how extreme the dumb money was versus the smart money. And then, of course, we saw that epic sell-off after we reached that extreme point. Well, the extremes went the opposite direction, where we had an extreme confidence issue out of the dumb money, and smart money was very confident. And subsequently, what we have seen since then is that start to that bounce. Now, the over bought, so to speak, readings on these, or the extreme readings on this chart, are now starting to be alleviated, where we're falling back down into that middle zone, right? And what we look for on these charts is, of course, those major extremes. That's where bad things happen. But a lot of times you'll come in here and you'll look, when we reach the middle of this chart, it kind of acts as resistance and we head back like this. We saw that happen here, here, as well as in here, where it came down in the middle and then turned back in that direction. That's what we would need to be careful of watching for right here, is if sentiment kind of got right back into the middle range. What that does is essentially that rubber band is no longer stretched, and we subsequently could head back like we were a month or two ago. So the key takeaway from this video here today is we have had a really nice bounce here over the last couple of weeks, but we are running now into some areas where it could prove difficult for this rally to continue. This would make sense on a lot of different fronts for us to start to see this rally stall out in this zone and kind of head back lower. All right. If that were to happen, the major levels on the downside that we would watch from a support basis would be once again that 2450 zone that the bears could not break us under last week, would act as that first support, and then that second one would be that 2200. So if we were going to see that higher low situation get put in, you would think that we would have a rejection up here and then a low put in somewhere in this zone before ultimately making that bounce. If we got underneath of that 2400, then you would be thinking more kind of that double bottom potential if we were to hold on this. And so those are going to be those areas that if we start to make a pullback here over the next week or two, we're going to pay very close attention to. As always, I hope you guys find this content useful. Again, if you do, please subscribe to the channel so that you see this on an ongoing basis. You can also reach out to me directly if you want to discuss anything market related. You can shoot me an email to mtedeschi@perspectivewealthplanning.com, or you can give me a call at 814-580-9881. I hope you guys have yourself a fantastic week. And as always, I'll see you guys next week. Take care.